Today, I'm going to go over how tax brackets actually work. Probably heard we have a progressive tax system. Essentially, that means the more you make in income, the higher the tax rate you'll pay. But it's not as simple as just having one tax rate and that's the rate you would pay on all your income. Instead, it's a graduated rate system, meaning that your income is essentially taxed in different buckets. The other thing about this is that there are multiple rate systems depending on what your filing status is. Well, filing status is essentially in terms of whether you're single from a legal standpoint or you're married from a legal standpoint. And if you're married, you can either file jointly, which means you're filing a single tax return with your spouse, or you could potentially file separately, which means you're married, but you're each going to file your own tax returns. And there is also what they call the head of household status, which essentially means that you're not married, so you're single from a legal standpoint, but you perhaps have someone, another dependent in the house that you're supporting. I'm going to just go over one or two of these just so we can kind of get the idea of how this works. But you can find this information easily online if you're curious how it pertains to your filing status and things like that. You can just Google, whatever tax year and federal marginal rates, and you'll be able to pull up these tables. So I'm going to go over if you're filing single first. So essentially, the first bucket that you have here is $0 to 9,950. It's actually taxed at a 10% rate. Once you get over that amount, then you end up in the next bracket, you're looking at 12%. So how this is actually working mechanically is, let's say you make $40,000 even. Well, you calculate how much 10% is on the first 9,950 that you'd be paying on that first bucket, and then you figure out the difference. So if it's 40,000 times 12%, add them together, that's what your tax would look like. So the next one's 40,526, and you're going up to 86,375, and that puts you in the 22% tax bracket. So our next bracket starts at 86,376 and goes all the way up to 164,925, and that puts you at 24%. So it starts to jump up there a little bit, and then now we're getting kind of close to our highest rate, but the next one is going to be 35%. That just means the income between 209,426 and 523,600 is going to be taxed at 35. Everything else is going to be taxed these lower rates depending on which bucket they fall in. So our last one, if you're fortunate enough to be in this bracket, is 523,601 or more. You're going to be paying the highest rate. So that's essentially how it works. This is just ordinary tax rates. So this is, the wages you earn. Remember, there are preferential rates for certain types of income. And so the more that you can maximize those preferential rates, especially as you're getting into these higher brackets, the better off you are. So you've got the capital gains rates, which top out at 20%, and you've got the preferential dividends rates that are also topped out at 20%. So you want to maximize those as much as possible. In the lower brackets, you actually get even lower capital gains rates. The more income you have in that category, the better off you're going to be.